right, let's get straight to the first corporate then. GPT Infra, the company recently raised close to 175 crore rupees by the QIP route. To understand what are the plans, what's the way ahead, how will it be used, well, we're joined by Mr. Atul Tantia, the ED and the CFO of the company. Hi, Atul. Good morning. Good to see you win. Well, there's been a lot of interest in the stock, and now you've gone ahead and you've raised money by the QIP. 175 crores is what you've raised. You've said it'll be used to pay down the debt. So give us a couple of numbers. The rough interest per annum is around 30 crore rupees. What was the debt? What does it come down to? What does it mean in terms of interest savings?
Sure. Thank you. So the debt currently on the balance sheet is about 190 crores. The interest number includes the finance cost in terms of the bank guarantees, which is typically the higher number for us. And so this reduction of debt will reduce the finance cost by almost 15 crores, which is almost 50% of what we had spent last year. This will directly flow to the PBT and help us in reporting better numbers in terms of the PAT.
Okay, and the debt that you said was 190 crores. It comes down to what?
It comes down to about 50 crores.
50 crores. Got it. Just one more question. You know, the promoter holding, as I see last reported, is around 75%. So the promoter holding will come down a little bit. But also it appears that part of the shares of the promoter holding is pledged or it's encumbered. Could you clarify on that?
Sure. So the part of the promoter holding is pledged to the working capital bankers of the company, which is led by SBI. This is towards the working capital limits of the company, and it is not for any other reason that it is pledged. This, as with the QIP route, as the debt pays down, this, as per the discussion with the bankers, this will also get reduced.
So by the end of this fiscal year, should we see the promoter pledge free, or say it's a story of FY26 when, you know, because from a share market perspective, you don't want the promoters holding to be pledged. So is there a plan to make it pledge free? If yes, by when?
There is a plan to make it pledge free. I think by end of FY25, we should see part of the pledge getting released, and FY26, we should see it fully getting released.
Right, you're getting fully releasing promoter pledges by FY26 is what you're saying, Atul, if I'm getting that correct, right?
Correct.
Right. So getting to the business aspect of things now, Atul, I wanted to talk to you about your order book currently at around 3660 crore, if I'm correct. Could you share a breakup of that? How much have you received in terms of order inflow so far in FY25, and what's the pipeline looking like?
Sure. So in terms of FY25, we received about 825 crores of new orders. This includes a large contract from RVNL for construction of the elevated corridor over the Kona Expressway in Calcutta. We do multiple bridge contracts for NHAI, RVNL, railways, and the likes. In terms of the order pipeline is quite strong, and we are continuously bidding for new contracts. With the infusion of funds via the QIP route, our net worth will improve, and we will be eligible to bid for much larger contracts. And that is the plan going ahead as well.
What will be the change in the size of the contracts, if you could quantify that, and also if you could tell us what is the what are the projects that you are L1 on currently as well?
So in terms of our current eligibility, we are able to bid for contracts up to 1,000 crores in our own name. The largest contract that we have on our order book is about 820 crores from NHAI for construction of a bridge over Ganga and Prayagraj. With this infusion of funds via the QIP route, we'll be eligible to bid for much larger contracts, about 1,200, 1,300 crores as such. L1 status, we normally don't declare, we declare as and when it is disclosed by the clients. So we will disclose that going forward when we come to it.
All right, Atul, I understand that you're guiding for a revenue growth of 20-25% for this year, but the start has been soft. In the first quarter, you grew only by around 2.5%. Do you stick to that guidance number? And also give us a sense on the breakup. You know, the infrastructure mix currently is around 93% of the mix. How do you see this mix evolving in the time to come?
Sure. So the current quarter, you have to be, the first quarter of this financial year, you have to be mindful, was an election quarter. With the elections, especially the migrant workers tend to go back to their native villages to vote, etc. So that leads to some disruptions. That is why the first quarter was slightly muted. We continue to hold on to our guidance of growing by almost 25% for this financial year. Rather, I should say for the next 3 financial years from till FY27 at least. And that is the number that we are quite confident of achieving as well. In terms of the segment revenues, 93% last year was the infrastructure business and 7% was the manufacturing of concrete sleepers. We expect that to be around 88 to 90% to be infrastructure and 10 to 12% to be the concrete sleeper business.
And by when would that happen, Atul?
So this financial year itself, we will see the concrete sleeper business is picking up as well. So this financial year, we expect concrete sleeper to be around 10 to 12% and infrastructure to be 88 to 90%.
And what about the margins in the railway sleepers business? I'm assuming you enjoy higher margins in that business, right?
So the Indian business for railway concrete sleepers enjoys a similar margin of about 13%, which the infrastructure business enjoys. The international business is at a slightly higher margin. So on a blended basis, we would say that the margin in the concrete sleeper business is about 14 to 14.5% compared to 13% for the infrastructure business in India.
Got it. So a blended margin I missed for the year. What are you guiding for?
Pardon?
Blended margin for the year. What are you guiding?
Okay, so blended margin, we have been always sticking to a hurdle rate of EBITDA of 13%. And we are guiding for a 13% EBITDA margin on a blended basis for the full financial year. That is a number that we are comfortable with, and that is a number that we have achieved over the last decade as well. So that is what we are guiding going ahead as well.
Okay. The other aspect is, it's good to see you're generating operating cash flows as well of more than 100 crores on a per annum basis. So that's good. Your working capital days have been gradually coming down. A few years ago, I think it was around 180 odd. That's come down to, I think, 105. Where does that number stabilize at?
So we expect working capital days to be around 90 to 100 days. It's a healthy number given the kind of contracts that we do, especially bridges contracts, which have milestone-based payments. And that is the number that we would be comfortable with. We should be able to achieve that in the next couple of quarters.
Give us a sense of your international business, Atul, especially Africa. What percentage of your order book comes from the continent? And there were some reports of some disruptions in Ghana as well. How are things shaping up on ground over there? And what is the kind of growth that you're expecting from the international business?
So in terms of the order book, about close to 175 crores, which is about 5 to 7% comes from the international business. We have 3 factories in Africa, one in South Africa, another in Namibia, and the last one in Ghana. These are for the manufacture of railway concrete sleepers in those respective geographies. They do supply to the local railways there. We are catering to a large market there. The market is very, very, I would say small compared to what it is in India, but it is a higher margin business for us. In terms of the political stability in Ghana, it's quite stable. It had faced its own issues with respect to IMF default, but that is something that they have kind of resolved. Our project is funded through the European International Bank, so we don't see any challenge with that.
Okay. All right, Atul, we appreciate you joining in. We're going to hold you to these numbers. Post the QIP, interest cost comes down by 50%. You're confident of growing by 20-25% for this year. Working capital days comes down. And margins hold steady at around 30% odd. Appreciate you joining in and giving us all of those details.